Hi, everyone. This is Mike Wilkerson, founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. 1 week ago Sunday, the Federal Reserve Board, alongside the FDIC and the U.S. Treasury, announced plans in the wake of the failure of Silicon Valley Bank to provide liquidity to U.S. banks in an attempt to bolster the capacity of the banking system to safeguard deposits and ensure that the ongoing provision of money and credit to the economy. That was their quote. Can we therefore trust that the U.S. banking system is now safe? So last week, I did a video entitled, Is Your Bank Safe? And I suggested that if the market concluded that the issues at SVB were bank-specific, i.e. not systemic, which was the narrative being told at the time, the storm might pass. Otherwise, financial contagion might set in. Based on this week's events, it appears that the banking crisis is going to get worse before it gets better. While bank deposits may be safe under the FDIC's new precedent of basically unlimited protection, whether you're insured or not as a depositor, the banks themselves are not. They're not safe. When one sees the storm approaching, it's important that you take a look and take shelter. So following the bailout of SVB's uninsured depositors and with additional lines of government emergency funding now available to U.S. banks, President Biden said on Monday, March 13th, that Americans can have confidence that the banking system is safe. The Federal Reserve Board said that the capital and liquidity positions of the U.S. banking system are strong and the U.S. financial system is resilient. And even though deposit flight continued throughout the week, the 11 too-big-to-fail banks, which stepped in to rescue First Republic Bank on Friday, March 17th, said the banking system has strong credit, plenty of liquidity, strong capital, and strong profitability. Recent events did nothing to change this. But is any of this really true? The financial markets certainly don't think so, and perhaps neither should you. In spite of the massive government intervention and encouraging words from both government and banking sector leaders, an estimated $550 billion of deposits have left the U.S. banking system this week. Banks were forced to tap the Federal Reserve's emergency funding lines for $165 billion, and the Federal Home Loan Banks, a government-sponsored entity that's mission is to support the banks, just raised $88.7 billion in new bonds to lend to a banking system that is no longer able to fund itself. U.S. bank stocks ended the week down 5% on Friday, and the NASDAQ Bank Index remains 25% below levels at the beginning of March. So the banking system is tottering, and the shriller the voices become insisting that everything is fine, the more we know we're in trouble. Take the case of First Republic Bank, which is the 14th largest bank in the U.S., is larger than was Silicon Valley Bank when it collapsed. Now, following the failure of SVB, depositors and investors reasonably asked what other banks might be at risk of a similar deposit run. First Republic was vulnerable, and over the course of just a few days, several $1 billion of demand deposits fled the bank. First Republic tried to find a buyer, but none emerged. And early on Friday, a consortium of 11 of the largest banks in the U.S. agreed to collectively inject $30 billion of deposits into First Republic to keep it afloat and to prevent financial contagion. Despite these actions, markets were not convinced. First Republic's share price ended Friday's extended trading day down 31% and down 84% since the beginning of March. Late on Friday, Moody's downgraded First Republic's credit rating to junk status, an action which followed S&P and Fitch earlier in the week. Now, these are all credit rating agencies that the banks rely on and investors rely on to establish a credit rating for the riskiness of their bonds. So lack of an investment grade rating places First Republic or any bank trying to access the capital markets in an untenable position. The cost of borrowing becomes prohibitively expensive and losses begin to mount as a result, worsening the bank's profit and capital condition. So First Republic appears to be a dead man walking. Moving on from First Republic, both investors and depositors will look for the next weakest link in the chain. And when the deposit run begins at that next bank, perhaps on Monday, perhaps next month, or perhaps not, but if so, will those big banks step in once more with additional tens of billions of dollars of liquidity support? And even if so, what about after that? Where does it end? There is not enough private sector funding to go around to solve a systemic deposit run once contagion kicks in. We know this, we saw it in the global financial crisis of 2008. So that leaves the US government to step in further. But neither the $25 billion US Treasury backstop of the Fed's lending program, nor the FDIC's $128 billion deposit insurance fund is anywhere near enough to protect the $18 trillion of US deposits. The Federal Reserve, the lender of last resort, is itself constrained. Inflation fighting through quantitative tightening and raising interest rates is now effectively over. The Fed's $8.6 trillion balance sheet is now good for one thing only, and that is to print more money, which means that inflation will resume its upward path this year. But a very troubling aspect, contagion is spreading to Europe. Credit Suisse, one of the world's largest investment banks, is teetering on the edge. So much so that on Wednesday, March 15th, the Swiss National Bank, Switzerland's central bank, equivalent to the US Fed, was forced to come to Credit Suisse's rescue with a $50 billion liquidity package. The Swiss National Bank, SNB's announcement followed the script from the US, so there was nothing to see here. In fact, they said, quote, the problems of certain banks in the USA do not pose a direct risk of contagion for the Swiss financial markets, end quote. And yet the Swiss National Bank felt the need to announce that it was providing a lifeline and that Credit Suisse was able to receive it. However, on the same day, Credit Suisse's largest equity investor, a sovereign wealth fund backed by the Saudi government, on that same day essentially walked away from its investment after declining to put in more money into the beleaguered bank. So this very weekend, as I record, the Swiss National Bank is trying to broker a deal for Credit Suisse with its Swiss peer UBS, in which UBS would acquire it and rescue the situation. But as of this moment, the parties are very far apart, and the Swiss government may be forced to consider nationalization of the bank, which would wipe out Credit Suisse's shareholders, certainly, and likely their unsecured creditors as well. Now, that won't be well received by the Swiss taxpayer, who will foot the bill for the acquisition and for further losses that Credit Suisse may have hidden away. We see that this is quite serious because on Friday, there was news that Credit Suisse's counterparties are now demanding to be paid upfront before executing any transactions as a counterparty, whereas the custom, and normally these things are settled later, either end of day, end of whatever period, not so now. And this breakdown of trust between transacting parties is exactly what caused the financial system to seize up 15 years ago, nearly to the day, leading to the demise of Bear Stearns. At that time, the global financial crisis started amongst the largest investment and commercial banks as a result of the securitization of overvalued or sometimes even worthless residential mortgages. In this current crisis, it's the regional and smaller community banks that could blow up first. And it's the collapse of the commercial real estate market that may be the match that lights the fuse. So, as an example, one way that contagion could spread is through the commercial real estate sector, which is today sitting on some millions of square feet of or underutilized and thus unprofitable office space as a result of the working from home trend that was started during pandemic lockdowns, travel restrictions, etc. So the entire sector is under pressure, and delinquencies and defaults are rising. Now, small and medium-sized banks account for 40% of all lending, but play a substantial role in CRE and commercial real estate, about 67% of the total market. So if the recession that is going on right now in the commercial real estate sector worsens, so too does the financial position of these small and regional banks. They don't have the liquidity or the capital buffers to absorb these additional losses. And any holders of loans or bonds, commercial mortgage-backed securities, will be impacted. And that also includes not just the small and medium-sized banks, but the big banks as well, which will similarly incur losses. I want to conclude this now and say that this is an ongoing developing story. We've seen incredible news come out almost every single day over the past week, and I suspect that is going to continue in the week to come. I will be providing updates as we go along here. And if this has been helpful for you, I would ask that if you're watching it on YouTube, that you like it, that you share it with others who might benefit from this message, and to subscribe to my YouTube channel. And check me out on stormwall.com, where you can read about this and other issues impacting our economy and the markets and the world at large. Thanks for joining, and we'll see you next time.